Good morning and welcome to the 6th Symposium on Regulatory Affairs. We're very glad to have you here in Toronto to hear our speakers who've come from around the world. We are going to have a terrific day. I'm only sorry that they didn't take my suggested title of the event, 50 Shades of Grey. But we will proceed forward, and we're very excited to have you here in attendance because without you, we couldn't have the event. My name is Robert McCullough. I'm going to be your MC for the day. And we have an exciting panel, and I'm looking forward to introducing you to them. So, let me first start off with the President and CEO of Advocis, who is a past high school teacher, particularly in science, past principal, past administrator, and exceptional leader. I'd like to invite Mr. Greg Pollock to the front to give us a few opening comments.
Thanks, Rob, and as well I'd like to echo your welcoming comments to this 6th symposium, which we hope to continue well into the future. The new professional. So I am on the opening panel this morning, and I'll keep my remarks, therefore, brief. But it is just a special privilege today to welcome you to this symposium with thought leaders from around the world, and this is a first for the symposium. We have two individuals from the UK and from Australia, and certainly we are looking forward to their comments on some of the similar challenges that they have been facing in their jurisdictions. So, as Rob said, my career started in education and specifically in the sciences. And so, as one would know, coming from the sciences, to every action, there is a reaction. And regulation and regulators are governed by this same principle. In Canada, securities regulators are considering, as we know, the institution of fundamental changes that, if implemented, would reduce consumer choice in how they access and pay for their financial advice. The question Advocis and others have been asking is, what would be the effect of such an action? For years, the answer to this question was speculative. No one knew for certain what the effect would be, but that's no longer the case. Today, we'll be hearing from experts in jurisdictions where this social experiment has already taken place, and they'll tell us what has happened in their home countries. We will also hear from experts who have modeled what the likely effect will be in Canada if we were to travel the same course. In discussing the Canadian context, Advocis has been speaking to regulators, governments, industry, and other stakeholders from across Canada, asking the same question. What problems are regulators trying to solve or avoid by reducing choice for consumers in how they pay for advice? We all share the same view. Consumers need access to sound advice to ensure that they are doing all they can to be in good financial health. I suspect that what we'll hear today will give many cause to pause, as the international experience to date suggests that reducing consumer choice in how they pay for the advice has resulted in those most in need of expert advice being priced out of the market. However, if the desired outcome that regulators are seeking is enhanced consumer confidence and access to professional financial advice, are there alternative regulatory options and tools available that may address concerns without following the path of other international jurisdictions? I believe that it's fair to say that there are. At Advocis, we believe that our submission to the CSA with respect to the duty of care and the banning of third-party commissions for mutual funds is a good place to start. We proposed a new go-forward solution, raising the professional bar. We have been engaged by the government and industry with regards to this concept, but have received little traction from the regulators themselves. Our proposition is that if professionalism was enhanced among all financial advisors and planners in Canada, then the outcome would be a better quality product for Canadian consumers, our clients. To me, it's more important that we develop our profession rather than have regulation implementation that does little to enhance the consumer experience or access to advice. In my mind, the banning of third-party commissions and altering the well-balanced fiduciary standard that has been developed over generations of common law holds little in the way of achieving meaningful benefits for consumers. I expect that today's panels will assist us in understanding the consequences of regulatory intervention and the effect it can have on determining what the markets will look like. I invite you all to listen carefully and reflect on what you will be hearing from our speakers today. So before turning back the podium to Rob, I would like to express my thanks to the staff at Advocis for the outstanding program that they have once again put on for us today. So if you join me in congratulating them on this program. And I'm certainly honored to continue working with these dedicated professionals. So thank you, Rob.
The first panel that we have this morning is led by a past chair of Advocis, and I would invite you to read the formal bios in the books that you've been provided. I'm not going to read the formal bios. I've gone to the effort of trying to find out other more interesting things so that these people become real. And for that, I'd like to introduce Ms. Terry Zavitz, who comes with a music background. You wouldn't believe it, but her background is in music, and she's a lifelong traveler. When she finished being chair of Advocis, she decided that she'd been around the world. The one place she hadn't been was the Antarctic, and she went off on a journey to the Antarctic. So we have a leader who's a musical professional with an amazing background in the business and also a world traveling. But she's most excited about becoming a grandmother in the next few months, which is amazing when you see her. So you won't believe that she could possibly be that old. This is being recorded, right? So the panelists today for Terry's moderated session starts off with Peter Interligi. And Peter is a terrific resource to our industry. He's a leader of Invesco. He has a very distinguished professional background. And he's actually taking surf lessons for the first time in May with his 10-year-old son. The interesting thing about Peter is I've seen his presentations before. He vets all of his presentations in front of his children. He says if they're child-proof, then they're good for the audience. They're going to be good. So we can't wait to see your presentation. We have a second panelist, Frank Swedlove. Frank originally was pretty skinny in what he was going to tell me, and I think he feared after sitting with me at dinner last night that I might say things that were unvetted. So he wanted us to know that he'd spent a year in Provence well before the book was written. He's the original man from Provence, and he studied French and Aix-en-Provence. So we're very excited to have Frank here. Frank's actually the head of an international organization, one in the public and one in the private sector. He's been to all regions of the world and 50 countries. He fears if he was ever to retire, he'd have to pay for his own travel, and we're pleased to have paid for his travel here. We have Joanne De Laurentiis, and she's an avid gardener. And she's telling us that she's gardened for a long time, and she loves her wild flowers and vegetables, and she was wondering, you know, in addition to having those animals eat her garden as their local salad buffet, she was wondering if anybody had a solution how to keep the animals out. And I was going to point out that in Alberta we have plenty of room for God's creatures right next to the potatoes. I'd like to introduce Ms. Terry Zavitz, who will come forward and lead this esteemed group. Terry?
Good morning. I'd like to ask the panel to come on up, and we'll begin. I will say that with the panelists, they're going to be giving a few-minute opening statement and a few remarks in regards to their area of interest and what they think we'll be interested in as well. And if you see me jotting down feverishly, it's because my job after that is to ask some very pertinent questions. Now, where you can really help me out is to develop questions of your own. And if you could bring them up to the front, either to Dave or to Rob, and they'll make sure I get them. And then I'll sort through them and make sure that they're asked of the specific panelists so that we can get their comments as well. So let the fun begin. I'd like to start with Frank, and just fire away.
Okay, well, thank you very much. It's certainly a pleasure to be here today. I do appreciate also Advocis paying for my travel here, since my office is across the street, and it was very generous of you to pay for me to walk across the street. I'm going to talk a bit today about how the world changed with the financial crisis in terms of regulation. Before the financial crisis, the world was kind of an easier place to be, and that was in terms of regulation, because domestic regulators basically did what they wanted to do. There really wasn't a lot of pressure in any way about how they did their job. And the financial crisis really changed everything. The world focused on financial regulation, and the main focus, of course, at the beginning was prudential regulation, solvency regulation, and it didn't really touch on market conduct for a while, but as one would expect, eventually regulators got to the market conduct issue and decided to make that more of an international area of consideration. And they focused on the catchphrase, treating customers fairly. And there's a recognition that the product needs to be sold fairly, the consumer needs to understand what they've purchased, and the product needs to be suitable for their needs. So that's kind of the base when it comes to market conduct regulation. Now, the G20 got engaged in this, and they asked the OECD in 2010 to start to prepare principles of market conduct regulation. And that has been done. And the focus of a lot of the work that's going on by regulators around the world relates to some of this OECD work. Now, the insurance organization that deals with international regulation is called the IAS, the International Association of Insurance Supervisors. And they established these international core principles, and which are called ICPs, and ICP 18 and 19 relates specifically to market conduct. Now, why should we care in Canada about this? Well, we should care in Canada about it because our regulators care. They care about it because they are held to expectations of international standards. Now, there was an FCAC, which is a financial services review by the IMF of the Canadian regime last year. And we actually did pretty well, and that's the good news. However, the insurance regulators have decided that it's important that they review their processes to make sure that they're very much up to date and consistent with international standards. So we're going to be faced with this over the next couple of years. And, you know, there's a number of things that have happened internationally, and Greg talked about it. It will, I think, significantly impact a lot of the things that we do. Generally in Canada, we've had kind of a cooperative system of regulation with respect to insurance companies. I think what has occurred with MGAs in the last couple of years, where the regulators and the industry work together to establish approaches to how oversight of MGAs would work, I think is a real good example of how industry and regulators can work together. But increasingly, I think that kind of model is going to be under pressure. One of the elements of market conduct regulation that we have in Canada really focuses in on principles-based regulation and the effort by industry to make sure that they follow the rules. Last year, the Ontario regulator, FSCO, did a survey about 1,400 Ontario life license advisors to find out how they dealt with product suitability. Unfortunately, about 50% of the respondents did not make written disclosures as required by Ontario regulation about their conflicts of interest. This is really quite worrying because in some sense there's an expectation that we will follow through in the commitments that we make. So FSCA is going to repeat the survey in another year to see if compliance rates has improved, and I think there's an onus on all of us to try to find and make sure that we respond in a positive way. So in conclusion, I think overall, I think our regulatory system stands up to international comparisons, but the trend is changing quite dramatically around the world, as Greg has made reference to already, and we see a lot of focus on disclosure and how compensation is set. And there's no question that our regulators are going to be starting to look at this, and it's, I think, important that we put our best foot forward to ensure that the regulatory system that we have in place today and its credibility, I think, overall, continues to be reflected in what we do. So that would be the key message I would provide.
Thank you very much, Frank. I'm sure that there is going to be some interesting questions come from the market or come from the floor with regards to what's happening in the market. I pass over to Joanne. Welcome, Joanne.
Thanks, Terry. And I'm delighted to be here. Thank you for inviting me to participate. I want to put forward three propositions or three contentions that we can explore today in terms of how we approach regulatory issues. First of all, that this is a great time of opportunity for financial services. The second proposition is that a key contributor to our stable and well-developed financial services industry is a robust regulatory framework. And third, that the industry and regulators need to continue to evolve the framework in partnership. So let me just elaborate on each of those, and then we can move forward. So on the first point, that it's a great opportunity for financial services industry, and in particular, I think the frontline advisory sector, because first of all, we've got unprecedented demand for market financial products. We're living longer, we're wealthier, so we're looking for more product and more advice. We know that we have to take a greater personal responsibility for saving, in particular for retirement. And third, collectively, we express a very high level of satisfaction in the products and services that we have access to. And that confidence is really well placed because we have access to a broad range of product. We've got a mature and competitive industry. We've got an able distribution sector, thousands of well-qualified advisors who are able to coach us through identifying our goals and the financial commitments and decisions we need to make. And the experience of those who work with advisors shows that we accumulate greater wealth. So the evidence is there. And I think this all points to the fact that we have a great industry and a great opportunities for growth. So moving to the second contention, that a key contributor of a stable and well-developed financial services industry is the regulatory framework that governs our industry. I'd say, we all know it builds confidence in the marketplace and creates a competitive and robust industry. We share the goal of regulators that we have to serve the best interest of investors. Canadians place their trust and their money with us, so they deserve to be looked after. And Canada, I would submit, has a very robust regulatory framework. This isn't just the view of those of us who live in it and under it, but it's held, it's expressed by external bodies like the AMF, who regularly audit our structures, and they do that across the world and then compare how we do. And while it seems that sometimes we are at loggerheads with our regulators, in fact, I think we all accept the need to collectively evolve the regulatory framework in a manner that serves the interest of the consumer. In a regulated industry, it isn't a once-and-done activity. There's always refinement that needs to take place, although I think we all feel at times it'd be nice if regulators took a sabbatical and gave us time to catch our breath. We accept that that may not happen. So my third point is that as a regulated industry, it's our responsibility to work with the regulators, but it's their responsibility to work with us, to identify the gaps and to close them as needed. And over the last several years, I would say our industry, particularly in the securities world, and the fund world in particular, we've been extremely busy in getting at those gaps. We've improved the clarity of information that the investor receives by introducing the fund fact, the all-encompassing client relationship model amendments, both phases 1 and 2, will transform the advisor-client relationship, beginning with the engagement letter that the advisor presents to the investor, setting out what they can expect in terms of services, the discussion about goals and risk appetite, the reporting of the performance and of the investment, and the cost. All of that fundamentally will improve that what is at the heart of the advisor-client relationship, which is the ability of the advisor to draw out, to get the investor to articulate their goals, their life goals, and then understand the financial commitments they have to make to achieve those goals, get them to develop a plan and stick to it. So I think collectively we need to work very hard to implement the rules that have been put in place, because notwithstanding that we have a robust regulatory framework, there is a view that the framework we have in place is just a disclosure model. And I think that is, that perspective is a mischaracterization of what we have in place. But what it's leading to is a push for our regulators to emulate the actions of regulators in the UK and Australia, and more specifically banning commissions and imposing a statutory fiduciary standard that Greg has alluded to in his opening remarks. Now, thankfully, Canadian securities administrators have, instead of rushing to rules, have issued a discussion paper. We all had the opportunity to comment. What they received from those comments was that there really wasn't a compelling reason, again, to rush forward, that they needed to do more empirical research. That's what they're engaged in right now, and we should get a sense of where that will lead them in terms of direction sometime in the spring. Now, as I said, I think that those who apply the label of it's just a disclosure model are completely missing the point, because we have a framework that is administered through a multi-layered structure that includes the provincial securities regulator, clear mandates to create policies and rules. And at the distribution level, we have market conduct regulators in IROC and the MFDA, which under the supervision of the provincial securities regulators, these are not self-regulatory organizations by any stretch of that term. They have tools to oversee, police, and guide the distribution industry. And it's not just about issuing rules, they also have a very hands-on audit process that they use. If you are an MFDA member, in the 12 years that the MFDA has existed, you will have gone through 4 complete audits of your shop. That's not just disclosure, in my view. And it's a very little known fact that Canada and the US are unique in having these very hands-on market conduct regulators. They don't exist in Australia or the UK. So what's our advice to the regulators? Because there's always room for improvement. So we've got a couple. We agree that enhancing proficiency requirements of advisors is a good thing. We're talking to the MFDA about bringing in mandatory CE credits. We think providing advisors with tools that allow them to more appropriately assess the risk appetite of their clients when they're setting up their accounts is key. The suitability question, we've got to get that right. And we think that, giving the SROs perhaps more tools to ban individuals from practicing anywhere if they have been banned in a province is a good rule too. So in summary, I believe there are great opportunities for growth in financial service sector. We have a very competitive and well-run industry, and in part due to the robust regulatory framework, and we should continue to evolve it and not be distracted by the noise from other jurisdictions, because we've done a pretty good job ourselves. So let me leave it there.
Thank you very much, Joanne. There's some good news there. I pass you over to Peter.
Thank you, and thank you for having me here. It's a pleasure to be able to participate in a discussion like this. When I first received the call, I was intrigued by the topic because I was asked to come with some blue sky ideas on things that I'd like to put on the table. So I've come with one idea. I'm not going to burden the group with more than one, but I think one that you might find interesting. With the regulatory environment right now, if you look at all the things we've been discussing ad nauseum for the past year to 2 years, disclosure, CRM2, the possibility of banning embedded compensation, the fiduciary duty standard, if you really examine what's at the crux of all this, it's really what we can do as an industry to change and evolve and improve the overall investor experience. I think, too, it's important for us to look to our regulators and ask, how can they change? What can they do to improve the overall experience for the investor? And one of the things that we take notice is there's a lot of pressure on mutual fund fees, generally speaking. The regulators will often look at the U.S. market and say, why are mutual fund fees lower in the U.S. versus Canada? It's often covered in our national newspapers. There's a lot of pressure on financial advisors that are compensated through the price of their mutual fund. And of course, when you're looking at MERs, they're looking at the total MER, which includes dealer compensation versus an MER that does not in the United States. So one of the ideas that I'd like to discuss and hope that all of you find interesting is this idea of passporting a product. Now, this is not a new concept, and we take a lot of time looking at other markets. Joanne mentioned in her comments as well that we look at what's happening in the UK, we look at what's happening in Europe, and one of the neat things that I think has happened in Europe is they've created a vehicle called a UCITS. Now that stands for Undertakings for Collective Investment in Transferable Securities, for those who are taking notes. But really all that means is that you can take a product and sell it in multiple countries. Now, if you look at North America, and we're, I would say, arguably two of the most sophisticated financial services markets in the world, yet when we prospectus a mutual fund, it has to be prospectused here in Canada as well as in the United States. Now, just to highlight the inefficiency of that, imagine you're a sneaker manufacturer and you're told that you can't sell the sneakers you manufacture in the United States. You actually have to build a factory in Canada, manufacture the same sneaker, and then you can sell it. That's what happens in the mutual fund world. Now, if you can create a passport-like product, and I'll use Invesco as an example. We have many portfolio managers that we use to manage products that we sell here in Canada. And when you look at the price of the fund, the mutual fund in the United States, it might be 85 basis points. And in Canada, we would have to sell it for 100 basis points. So it begs the question, why the price difference? Well, it's very, very simple. For starters, with many funds here in Canada, you just can't build the scale necessary to get to that 85 basis point management fee. The second is that when you have to replicate the entire infrastructure, whether it's cutting NAVs, having the transfer agent, et cetera, that adds cost as well. So the concept that we're proposing to our regulators is let's introduce passporting within North America. This way, if there's a fund that's already prospectused in the United States, you can actually sell it at that price point, that 85 basis points in the example I just gave, versus replicating the manufacturing capabilities in Canada and selling it for 100. I think it's a very easy solution, and and I believe our regulators are working in the best interests of investors. If we're doing that, then this is something that the SEC and the CSA could do together to figure out, where is the common ground? How can we get that transferability or that passporting capability so that we can pass on lower costs for the end consumer? So that's my blue sky idea.
Thanks, Peter. We'll look forward to exploring that more. And now, Greg.
Thanks, Terry. Again, Welcome to the symposium. As I thought a little bit about, what kinds of issues are sort of top of mind for me as I look at our current agenda, it's busy. And a lot of those issues actually are regulatory issues. So, for example, in Ontario right now, there is a review of the credit unions. And clearly that affects all of us, whether in the credit union environment, the banking environment, or independent financial advisor environment. That's an issue that we all collectively need to understand and work on together. We have the cooperative capital markets regulatory implementation, if you want, that is occurring. And I found it rather curious in looking at the draft legislation, because the draft legislation is out there, that the definition of a security has been changed from the current definition of a security within security acts across this country. And it's changed in the way that it will now be able to include, with proper regulatory approval, it will now be able to include seg funds. Well, seg funds are an insurance product. So, how is it that we have this kind of discussion going on with securities regulators when at the same time, the insurance regulators really have made, in my understanding, very little commentary on it, and I'm sure the insurance manufacturers are extremely upset, frankly, with this kind of direction. What it really points out is that there isn't efficient and effective collaboration within our overall regulatory environment, and I find that quite troubling, in fact. And even more so, financial advisors who are dealing with all of these products. A vast majority of financial advisors, as you'll hear later today, in this country, are licensed on both the investment side of the industry and the insurance side of the industry. So, they're dealing with all of these various rules and regulations. Wouldn't it be best to, consult with them beforehand, find out what these professionals think about these issues before we go out and broadly, if you want, introduce legislation? Sure, they're looking for consultation on it, so we'll provide it. But it seems backwards to us. And we see this time and time again with regulatory reform in this country. Advisors are really an afterthought when it comes to, what would be good from a regulatory perspective in this country. So, of course, the issue of statutory fiduciary duty, the issue of embedded compensation, I referenced those earlier. I won't get into any more detail on those, but those are major issues for us, I think, currently in Canada. And as I alluded to, we really need a new focus. And the new focus is professionalism. That's what we need to stand for as an industry, if you want, of financial advisors. Now, it's beyond just financial advisors, and clearly all of us need to work together in order to effect good outcomes for our clients. But by new professionalism, I'm speaking about higher standards when it comes to education. This is not to say we have poor standards today in the country. I want to be clear on that. We have very good standards today in the country, and there are very few financial advisors who actually receive complaints by their clients about the advice that they provide or the products that they recommend. But still, one is too many, and if we can improve on that, we should. So consumer protection, again, another hallmark, greater transparency. Do people have easy access to disciplinary histories? Are people able to transfer jurisdictions and so forth? Those are issues. A standardized, if I can describe it that way, a standardized professional code of conduct so that we all understand what is expected of financial advisors in this country. And what about the entrance requirements into the profession? We have the most highly educated population in the world. And in my view, it would not be a big stretch to require that everyone entering the financial advice industry in this country have at least 1 year of post-secondary education. I'm sure that would include 95% of the population already, or pretty high percentage anyways. That's not a high bar, but let's start somewhere. I think that would be very good. And then, creating a profession, we've talked about that for quite some time as an association. There are some challenges with respect to that. There's no doubt about that. We want to provide clear advice to all Canadians. So how do we meet both of those objectives? I think we can do that. Now, I was interested to hear what Joanne said in terms of, I think some of the regulators are hearing us with respect to the issue of embedded compensation. And certainly we are hearing some similar things. But I was also interested to read last month in Investment Executive a report that was referencing a CIBC World Markets report. And I don't know whether you folks saw this, but I guess this is, is CIBC going to be, are the banks going to be good bets moving forward? And they were speaking specifically on the banning of compensation embedded in products. And this is what the report, the CIBC report, stated. It indicates that a ban on trailers is likely for a couple of reasons. For one, regulators are devoting much time and attention to fundamental retail investor protection issues, and the report suggests regulators will not want all of this effort to go to waste. For example, the CSA, and you just referenced this, Joanne, recently commissioned a couple of independent research reports to examine the impact of industry compensation structures on both mutual fund sales and investor outcomes. At the same time, the CSA is also engaging in a mystery shopping exercise designed to test the advice that retail investors receive in the real world. In addition, regulators are still contemplating the need to impose a fiduciary best interest duty upon those who provide financial advice. And the article went on to say that without trailer fees to provide an automatic revenue stream, financial services firms would focus more intently on their wealthiest clients while pulling back even more from smaller clients. Now, if that's what you're trying to achieve as a public policy, then this is probably a good move. But if that's not what you're trying to achieve, if in fact you're trying to educate Canadians, this is Financial Literacy Month, right? If you're trying to help Canadians become more financially literate, working with their financial advisors, and somehow interconnected, with the internet in terms of all the information that's available out there, this is not the way to go. So that's partly why we commissioned our report, Sound Advice, and that's going to be referenced on another panel today. So I won't go there, but let me just conclude that really as financial advisors as well, we need to get our act together. And if we can just bring up that Venn diagram for a moment. We need to get our act together and help consumers understand who we are. I've met with some of the major consumer advocates in this country, people who I think you would, thank you, people who I think you would highly respect. And, they've said to me, Greg, look, you've got this alphabet soup of designations out there. Can you just make it simple? My members need to know. So you might know who I'm talking about, right? My members need to know that if they're talking with a financial advisor, that they're going to have their interests in mind and they're going to deliver on what it is we're discussing. And, so I spoke, about all these designations. Well, what about the CLU, the CFP, and, CHFC, and TEP, and so on and so forth? Not a problem. We don't have an issue with specialization. You can have your medical doctors if you want, but you have lots of specialists, and we don't know what all those specialists do. The oncologist, the cardiologist, the urologist, and so forth. But we know generally what a medical doctor does. Well, if we know generally what a financial advisor does, it really doesn't matter the specialty, whether it's tax planning, financial planning, estate planning, and so forth. And last night when I arrived home, I picked up the Atlantic, and the big story on the front of the Atlantic was, why kids sext. So that kind of got my attention for a second. And so I flipped it open, and on page 45, there we go, large ad by the CFPs in the United States, right? And it refers exactly to that Venn diagram we just showed. This financial advisor wants to. So describing a CFP as a financial advisor, this makes sense. This will be clear for the public that whether you're a certified financial planner, you know, an estate planner, a tax planner, you're all financial advisors. You all subscribe to certain standards. And if we could convince the public that that's what we do collectively, I think that would go a long way to addressing many of the issues before us. So I'll leave it there, Terry.
Thank you very much, Greg. And again, I would like to remind you that if you've got any questions, please bring them forward. And David's up here, as well as Ed. Rob's up here. So please give them to those people, and I'll make sure that I get them, and I'll ask them the questions near the end of our presentation. So I wanted to go back to Frank. You've been sitting there quietly, and you had some really interesting comments that were made. And one particular that I thought was going to be of interest to the audience is the FSCO survey. So for those of you who don't know what that was all about, FSCO decided in Ontario that they would put together a survey, and they went out to over 1,000 advisors, and it is required by regulation that advisors complete this survey, which they did, and then FSCO released its results. And the results actually overall were pretty good, pretty good. Advisors were doing what they were supposed to do in the life insurance industry, but one very disturbing fact, as Frank pointed out, was that only 50% of the advisors were actively talking to their clients about conflict of interest. And this is regulation. We have to be doing that. And as well as doing that, we also have to be filling out forms on product suitability. And this is required as well. And so, Frank, I wanted to know from you what the insurance industry is looking at with regards to oversight on advisors, on life insurance advisors, in regards to those stipulations that are required. Because in my personal opinion, and in my personal experience with regards to an insurance world, I do have maybe 2 companies that regularly ask about the types of forms that I use, and one in particular that does do audits, but really there's not much else. So I'm wondering if you can comment on that.
Well, it's obviously a good question in terms of responsibility to ensure that agents follow the requirements of the law clearly here. The process that we have in place is that the Canadian Life and Health Insurance Association has guidelines. And those guidelines are basically rules of the road that we request that our members follow. And we're very pleased that our members almost invariably do follow them. And with respect to issues related to what you just talked about, we do have a guideline that covers that. And so while it's regulation in Ontario, it's not regulation in a number of other provinces, but we put an onus on our companies to ensure that these rules are being followed essentially by the agents that they deal with. And I think overall the system works well. Obviously it's always an interesting issue when you have that relationship between the company and the agent where obviously the company is interested in having the business. And so, but I think our members do take the oversight responsibility quite seriously, and I think or they do take it seriously, and also, of course, with the MGA focus of the last year or 2, I think that's, if anything, stronger. So I think the system overall works well. But I should also note that, of course, an agent has a responsibility as a licensed agent to meet the requirements on his or her own, because they are licensed and regulated directly by the province.
Terry, could I make a comment on that as well?
Yes, absolutely.
Thanks. Because I don't know that people know that there were a number of advisors, I don't know what the number was, roughly 100 or 110 or so, that did not fill out that survey, did not respond. And as Frank is maybe suggesting, there's an obligation under the Insurance Act in Ontario to do that. So they have received an invoice recently from FSCO for $1,000 because they forgot to fill out the survey. And so that's just a little gentle reminder that, in fact, if you are licensed in this country and in this province under certain legislation, you have responsibilities. And I was with 100 of our members yesterday and just sort of passing this on. And so the immediate response from one of them was, well, yeah, but what about those millions and millions of dollars in fines that are out there against various individuals that are never collected? Couldn't they collect that money first? I said, well, I see that point. But you as professionals are obligated to respond to your regulator on these kinds of issues. So I think it's a good thing.
Any other weigh-in from the panel before I go to our next question?
Could I go rogue here and comment on Peter's suggestion?
Absolutely.
In a previous life, I was the negotiator for financial services in the NAFTA. And what Peter was suggesting was very much an element of the discussion in the NAFTA. And I think in Canada, there's a general willingness to have mutual recognition of other regimes and to find a way of resolving these kinds of issues. The difficulty that we had in those negotiations were the Americans, and particularly the SEC. And the approach that the SEC took was, while we have a close relationship with Canada, and that's nice, how do we tell another jurisdiction that we have concerns about, potentially about their oversight, and that we may not be in a position to recognize their regime like we could recognize Canada. So I think the reticence of your idea came more, in terms of actually doing something, came more from the US regulators. And I'm not sure that that's changed much since.
Yeah, one of the directors on our fund advisory board was with the OSC at the time when those discussions were happening that you're referring to. And my understanding is that the US did make some progress with Australia in terms of mutual recognition, but then there was the financial crisis. So I'm not quite sure where they ended up in that discussion. I do think, though, that if the industry gets involved, and you look at some of the global asset managers, BlackRock, Vanguard, Invesco, Fidelity, Templeton, et cetera, I think there has to be not just an effort in terms of communication between the regulators, the SEC and the CSA or our provincial regulators, but I think it has to be an industry-driven discussion. And I think it can be fruitful because we can point out the obvious inefficiencies. Canadians can buy US-listed ETFs, but they can't buy a US prospectus mutual fund. It seems odd that those types of rules exist. And as I said, I mean, there's great efficiency to be gained and great cost savings to be gained by the end consumer here in Canada if those types of issues are worked out.
Joanne, any comments on that?
We haven't, it hasn't come up as an industry question. We certainly follow the European UCITS model, and it's been extremely successful. They are, the UCITS are recognized in Hong Kong and other places, so it certainly puts the fund firms who are operating within Europe in a very competitive and good position vis-a-vis the rest of the world. I mean, I share Frank's view that the big issue for us would be, will the Americans go for that? They're very insular when it comes to regulation. Even the way that they react to the international guidance that comes out of groups like IOSCO. We tend to follow the leader and do our part as good participants. And the SEC generally kind of says, well, yeah, if we like it, we'll do it. Otherwise, whatever. So I think that's the big challenge, and it's worthy of discussion for sure. I think Peter makes a good point, but it's going to be a challenging one.
And you see that in accounting, for example, the IFRS rules.
Exactly.
The Americans have already stated that they're not going to follow the insurance approach in IFRS. Or the fund approach.
And we've already fallen in line.
Right.
It's very interesting to see the number of questions that are around the passporting issues and what that will mean to the mutual fund industry, the industry as a whole, and what are some of the things that are stopping them. Joanne, I wanted to go back to your comments with regards to the framework that Canada already has. I think it's very interesting because we can read so much negativity into the articles that we have in the industry journals, newspapers, etc., with regards to the industry framework. And I think what you were really saying is that we got a great thing going here. Just because we may have embedded commissions or we may have some other things that are being publicized, we have a great number of regulatory issues already in place that protect the Canadian consumer. And I'm wondering if you can expand a little bit more on that, about what Canada has that other areas such as the United States or Europe, especially the UK and Australia, doesn't have.
Sure. Well, starting with the SROs, which are, I think, really misunderstood, and certainly they, in some ways, it's a light that we have under a bushel. The fact is that Canada and the US are unique with SROs, these hands-on market regulators. And I've just come back from Australia, where the international investment funds, my colleagues from about 27 countries were there. And as I was describing the requirements, for example, of CRM2 and the very granular level, the very specific requirements that advisors are going to be operating under in terms of the discussion they have with the investors, the information they have to provide, the suitability test that they have to go through. I was inundated with requests for that information. Send it to me. We want to see it because that sounds really great. Both the Australian and the UK representatives said they didn't go that route first. They really, in many ways, they looked at the big picture and almost, are operating. I think, from my perspective, they're operating with a hammer and nail. Let's get a hammer, let's hit the nail, as opposed to what exactly are we trying to solve here. So I think that's a key difference. And the fact that we have a very collaborative, even though granted at times we don't feel that we have a great collaborative discussion with regulators. In fact, we do. That's somewhat different. There is a greater formality, my sense is, in the relationship in many countries between the regulator and the industry. They're not talking to each other. They're not understanding what the specific need is or what the specific change needs to be. So that's a flavor.
Thank you. Any comments from the rest of the panel on that? Okay, I'm going to pass it on. Greg, I'm going to talk about the credit union review. What relevance does that have into the financial advisor channel that you see? And is there any correlation between that and the recent, I think it's the Supreme Court decision with regards to the vulnerability of the Canadian banks, if there's any issue with regards to creditor insurance?
Right. Thanks, Terry. I think the main thing is on the market conduct side. And, if we're going to have distribution of product that's traditionally done through independent financial advisors, happening through the credit unions or through the banks, if you want, because that discussion will come up in a couple of years. We clearly want to ensure that there's a level playing field and that individuals who are providing that advice are properly licensed. So that's a big part of this discussion as we move forward.
Okay, any discussion with that? I'm going to go into, again, concentrating on insurance just because of a question that I just received. And it goes back into Frank. Frank, where do we stand on making written disclosure a mandatory part of the life insurance application process? It speaks to professionalism and self-regulation. Now, this comment was, while this current system is clearly not working, I don't know if you would agree with that or not, but it is part of the question.
So written disclosure, sorry.
Written disclosure, a mandatory part of the life insurance application. I would imagine that's about product suitability. Product suitability, why this product is better than another, why this one is used with this company.
Yeah, well, I mean, I really can't speak for the companies and all the companies in terms of their views on that. And there may be different views with respect to whether the present situation is is completely adequate or not. But I think overall, we're of the view that the system we have in place works well, and that consumers are properly informed and protected. And so I think that we generally support the regime that we have in place.
Right.
Terry, can I just add a
Yes.
comment? Because I'm not sure where the question is going, but it might be, again, that number you referenced, Frank, about half of the individuals not properly disclosing conflicts of interest and so on. And that just suggests to me that we have, some more work to do collectively with insurance advisors in this case throughout the province, and likely similar results throughout the country, although I don't know for certain. Advocis has for some time put together a best practices manual that in fact addresses all of these issues. And I think, again, if individuals were more compelled, if you want, to work with these kinds of organizations, I don't want to just promote Advocis, but if there are similar organizations out there, as the IFB, for example, then I think that would be very helpful in terms of achieving some of these ends. In speaking to the regulator, and in fact, AdFisco was just in our offices recently, and in speaking to them, they said, look, a number of these people were licensed many, many, many years ago, and so how do we keep them current? How do we keep them up to date? Do they know about the new changes that have been approved, in the Insurance Act and so forth? And how do we collectively help advisors understand that? I think those are important questions. So I think that's what that points to, and we have some work to do, for sure.
Yeah, I don't want to suggest that everything's great. I think that there is, but I guess our view is that the present structure we have in place can work, but we just have to work at it to make sure it does. And that responsibility lies with companies, with the agents, and also with the regulators.
I'm going to go back to Peter now. And Peter, you talked about the fees within or the MERs within mutual funds. How would the impact of the passport system potentially affect that? How would it affect the mutual fund industry in Canada? And lastly, third part to this question, can you go back over some of the differences in the fees between United States and Canada and what accounts for those differences?
Sure. I'll start with that first. In the United States, they have what's called a 12B1 fee. That's equivalent to a trailer. It's 25 basis points versus a standard equity trailer here of 100 basis points. But what's a little bit deceiving in that is that in the United States, about 80 to 90% of flows are in fee-based accounts, which have a wrapper fee. And when you look at those wrapper fees, they typically average around 1%. So when mutual fund companies are disclosing their MERs, they're not disclosing it after the wrapper fee that the dealer charges. They're just showing their management fee. The second difference in MERs is that in Canada, and this often gets, I think, ignored, we have the HST, the Harmonized Sales Tax. It adds about 20 some odd basis points, call it 25 basis points to the cost of a mutual fund. And that doesn't exist in the United States. There's no sales tax on mutual fund fees. So those are the two primary differences. The second question was, how would passporting affect the industry in Canada? I think ultimately the only impact is lower fees for the end consumer, because with globalization and companies like Invesco, they're going to be able to bring the economies of scale to the Canadian consumer. I suspect that a passported product would probably have to fit in a fee-based environment because it's prospectus in the United States. They won't have the embedded compensation inside the cost of the mutual fund. So that doesn't mean that all the other purchase options go away. We've long been advocates of having choice and flexibility in the marketplace. My experience, frankly, I know, Greg, you read the report from CIBC that says commissions will be banned, and this is where the regulators wanted to go. I've personally met with the chair of every provincial regulator in this country, and I can tell you that the perspectives, the range of perspectives, basically span the entire spectrum. Those that don't think it should be banned, right up to those that maybe it might be a good idea. So remember that in order for something to happen in Canada, all the provincial regulators need to agree to move it forward. So I don't think it's as imminent as some might believe. I think we've had good dialogue with the regulators. So we are making progress. It has been more collaborative. And I think CRM2 will have a significant benefit to the consumer and eliminate the need to have to ban embedded compensation, because how an advisor gets paid, whether it's through the cost of the mutual fund or paid separately in a fee-based account, shouldn't matter.
I will just extend that question a little bit more in light of one of the questions that I have just received, and that's more in regards to the DSCs, or the front-end loads, and how well they are explained to the consumer and the requirement to explain those charges to the consumer.
Yeah, listen, again, my belief is that all fees should be disclosed to the end consumer. I don't think there's a single person in this room that would buy any good without asking how much it's going to cost. So when it comes to the DSC, I think it does get abused by a small fraction of the advisor population. But when you look at when it's used properly, it actually does make sense. So let's bring this down to an advisor who's got 300 or 400 families in their book of business, and so one of their top clients says that their cousin Sue would like to have access to the financial advisor, but she's coming in with $15,000 or $20,000 to invest. I think in those particular cases, the advisor needs to get paid. The expectation by that client is going to be that they're going to get the same attention and service that their cousin's getting as a top-end client. And many advisors take these clients on because they want to grow with them. They want to see them save their money and so on. And I think the DSC in those situations makes sense because the advisor has to get paid. Now, if the client understands that there's fees for getting out of that product early and not within that DSC period, and you have situations where an advisor is redeeming and then putting them in another DSC product, I have no time for that. I don't think any principal advisor has no time for that either. That shouldn't be allowed. But as far as a purchase option is concerned, I think the DSC has some applicability, but when you look at the industry trends today, the vast majority of flows are going in 0% front-end sales.
Thank you, Peter. Any comments from the rest of the panel?
Just on the, Terry, just on the fee comparison, we had third parties, Investor Economics here in Canada and Strategic Insight in the US do what I think is a definitive study on comparison of fees between Canada and the US, and they brought out the key differences, including the two that Peter mentioned. But the other thing that they pointed out is that the fee structure, the predominant fee-for-service structure in the U.S. is showing some concern around churn, for example. So and so the regulators are actually looking at that issue. But the fundamental conclusion of that, those two studies, was that if you compare the total cost of ownership, is what does it cost the individual to own the mutual fund, then despite the the huge differences in economies of scale and the broad range of products, the size of the market in the U.S., we are virtually the same. The big exception is the HST, and we have been having discussions with the federal government to say, you know what, it's time to look at that HST that applies to MERs, recognize that it's taxing savings, and do something about it.
Thank you, Joanne. Greg, I wanted to go back into your comments with regards to seg funds coming under the definitions of securities, and how likely that would be that there could be regulatory approval of, let's say, the banning of commissions or some kind of regulation from a security side over the seg funds. And I'm going to marry that question with the whole idea of the thought process of banning embedded commissions within securities, and perhaps reaching over into life insurance and into seg funds.
Right. There's no doubt there's a kind of an analogy between those two topics. Clearly, just to be clear from Advocis' perspective, we're opposed to the cooperative capital project, if you want, redefining securities in this way. We're very confident that the way seg funds have been regulated in the country to date under the insurance regulators works very, very effectively. And certainly we will be bringing that position forward to the CSA in our submission as we prepare that. But on the other question about, if there were a ban on embedded fees, and by the way, Peter, I agree with some of the perspectives you've been hearing across the country. Certainly we've been hearing some of those things as well. However, we continue to have extremely influential people in this country, particularly the media, who continue to say, this is the way to go. And so it's my view that we need to push back because at the end of the day, we're going to do a disservice to Canadians. But if it were to happen, that embedded fees attached to product, were banned on the investment side, it seems to me that there would be tremendous pressure then to have that happen on the insurance side of the equation as well. So I don't think, sort of as the insurance side of the industry, we can just sit back and say, hey, you know what, we're fine, there's no issue, because there will be pressure if that direction occurs. I think the CRM2 project is the thing to keep our focus on. It's not clear, what those outcomes are going to look like until probably 2017, 2018. Let's do the follow-up surveys in those periods. And then if there are continuing challenges, let's find solutions collectively.
Any comments on that from the rest of the panel?
I guess just in terms of the issue of SEG funds being included in the securities legislation, the way that that's being approached is kind of sneaky, frankly, because what they're doing is they're not saying that SEG funds is going to be included now under securities legislation. In fact, the carve-out of SEG funds that is in the existing securities legislation remains. However, they add this little phrase, except as determined by regulation. And as Greg mentioned to me yesterday, it's better to fight the battle on the beach as opposed to in the town. And I think that's very much where we are also. If that were to take place, obviously, we'd be taking on another 7 or 8 regulators. And the whole purpose of this, bringing a common securities regulator structure, is to reduce the number of regulators. Yet for the insurance industry, there's the potential to actually increase the number of regulators that we would have. And so it seems to be a very odd approach by the government to even consider this. And so we join with Advocis in arguing strongly against it.
Thank you. Joanne, I wanted to ask about CE credits, and there was a question that was brought forward with regards to where we are at, what needs to be done to advance this along. So since I'm not quite sure where the mutual fund industry is in regards to CE credits, I'm not sure where advancement is, but I'll pass it out to you.
Sure. Most companies are providing CE credits. They're doing a continuous education, information, upgrading that with their distribution network, with their dealers. But there isn't a formal program. So within the IROC world, there is a formal CE credit program. Within the MFDA world, there isn't. And so we've recognized that part of advancing and demonstrating a high standard is to standardize, rather than just leaving it as voluntary. So we've come to the point at IFIC that we think it's time that the MFDA actually created a formal program. It will allow companies who are doing it now to get the credit for what they're doing. It'll allow individuals who are seeking, which I think is the vast majority of advisors in any event. I mean, today you're giving CE credits as well. It'll allow us to formalize and standardize that in a way that demonstrates our commitment to achieving a higher level of professionalism. So we expect to see a discussion paper coming out from the MFDA, probably early in the spring, and we'll get on with it.
There's a question here. I think it's very interesting because Joanne, Frank, and Greg especially, you've talked about regulators and listening, and that there is some collaboration between the industry and regulators that perhaps isn't found elsewhere. So I have a question, and I guess it just is, you know, the honest question. Are regulators really wanting to listen and learn, or have they made up their minds already? So Joanne, I'm going to pass to you.
Well, some days I would say they've made up their minds, and I'm very depressed about where things are going, quite honestly. But no, I really, you know, I think we have a great group of regulators. You know, certainly our experience so far on the fee issue and the fiduciary standard issue, I think demonstrates that they are, that they understand that if they move precipitously without really understanding the impact, or in fact understanding the problem we really need to solve, that it's not going to be good for the investor. You know, they recognize the value of advice. You know, it was interesting the other day, the Investment Education Fund here in Ontario, which is funded totally by the, you know, money out of the OSC, came out with an analysis, a survey that showed that by giving individuals better, clear information, you know, getting them financially, you know, improving their financial literacy, improves the dialogue they have with their advisor. And that dialogue is absolutely key to getting individuals, to helping individuals achieve their objectives. So I think the regulators get that. Sometimes, you know, they're more enthusiastic than we'd like them to be, but you know, I'm comforted by the fact that they're proceeding with a very specific research approach. I really disagree with the analysis that's come out of the CIBC analyst, as well as, I think there was an RBC analyst report as well. I think they've you know, reached conclusions that are not based on fact, so.
Can I just make a comment
Yes.
on that as well? My experience with each of the regulators is they, as much as we in the past have felt they weren't listening to us, I get the sense they felt we weren't listening to them. And so I think someone on the panel earlier talked about how, you know, there has been a combative relationship between the industry and regulators. Myself personally, I feel that we are making a very, very good progress in that regard. I think there's mutual, there's dialogue now. They clearly have certain things they'd like to see the industry do. And I think they're listening now to some of the ideas that we're bringing to the table in terms of what they can do to positively influence the industry as well. One of the ideas that hasn't been talked about yet today, and I think is a very, very important one, because frankly I think it's the biggest issue facing Canadian investors, is tide selling. You know, if we're going to deal with conflicts of interest, then, you know, we need to make sure that there aren't specific incentives built in place to sell proprietary product. I've used an example before, but imagine I was your doctor, your physician, and I worked for a pharmaceutical company. I worked for Pfizer, and for every elbow pain, knee pain, shoulder pain, I prescribe a Pfizer drug to you. Now, you might say, well, that's fine, but what if I also told you that I sold you enough medication to be part of the President's Club, and my wife and I got a trip for two to Vegas? You know, would that make you feel a little more comfortable? So I think, you know, when you look at the market today and you look at the, you know, the amount of assets that are sold in proprietary products, I think it is something the regulators should be taking a closer look at. And, you know, with the question, you know, are the regulators listening? I think they are. I think they've taken notice on these issues, and they've gone to market with a survey recently that we're going to respond to, and I think it'll start to get to the heart of the idea of tide selling.
Sorry, Frank.
Just on that, last 2 years I've been head of the World Insurance Federation, and which has 90% of the world insurance business. And so I've seen regulators from all around the world. I've met with them. And I think we're very fortunate in terms of the regulators we have. I think basically there is a difference between insurance regulators and securities regulators that also regulate mutual funds. I think the security mutual fund world is a little more rules-based. And it's more formalized kind of rules that exist. While in insurance, I think the focus has been more a principles-based regulation, which allows for more broad-based discussion and more discussion and dialogue before decisions are taken. And that's one of the reasons that I have particular concern about SEG funds coming under securities regulation, would be the quite different approach to regulation that exists between the security side and the insurance side today. So I'd note that element of caution. But overall, I think all our regulators in Canada, relative to world regulators, are listening and and do support dialogue and consultation.
Greg?
Yeah, I'd like to just echo those comments. I don't want to leave people with the impression that we're, constantly, fighting and so forth. In fact, doors are always wide open. I will say that the CCIR, tends to sort of hold the, the annual consultation with stakeholders and so forth. CSA not so much, to be candid, but still very, very approachable, on all these issues. It's a little frustrating. When you get, for example, let's take the statutory fiduciary duty and the embedded comm papers. When they came out, and I can't recall exactly, but each paper was about 60 or 80 pages in length with, all of these appendices. So we have to hire an army of lawyers to, write a response so that, our lawyers can talk to their lawyers. And I really wonder, is this an efficient use of our overall resources? And you look at the compliance costs going up with the regulators, and the number in my head is total cost about $330 million in 2007. Total cost in 2012 was about $550 million. So a growth of $200 million in regulatory oversight costs in the country. Are we really getting benefit from that? So that's what I want us to be looking at together as we move forward.
Well, it's interesting. I heard a talk the other day where the thought process is that the repercussions that came out in the financial services industry because of 2008 was likened to blaming the weatherman for Katrina. So I'll leave it at that and won't show my bias. And I guess then when we come into regulators, we just have to go through these last two questions because they're so pertinent to what's already been said. And so I'll ask for anybody's comments on there. The one is, given the UK and others have no SROs, can it be said that Canada has too many? And then kind of going along with that whole thing, it was, to whom are the regulators accountable? So, who's responsible for the unintended consequences of regulatory changes if banning of commissions may result in significant loss to the Canadian consumer? I mean, ultimately, who is responsible? So I leave that wide open to anybody on the panel.
I'll start. Ultimately, it'll be governments that wear it. If it goes south, there's no doubt about that. And I'm not so certain that that the ministers and staffs are as well briefed on these issues as some of us would think. And I think as long as things are going well, frankly, the regulators will be left alone, and I think that's really not a bad thing. But if they do start to go south and it becomes clear that there is not available advice for lower investors, if you want, then that will become a significant problem, and it could become a political problem. And so I think it's important that, that legislators understand that responsibility. It is a complex area. And when you go in and speak with legislators who've been around for a long time, in fact, and you're speaking to them for 3 or 4 or 5 minutes, they go, okay, so you're the auto insurance people, right? I mean, they don't really understand what we do. It's just very complicated.
Yeah, I would say, we have a collective responsibility, and the greater responsibility, whether we like it or not, really falls on us, the industry, for a number of reasons. First of all, I'd say that, when you look at the relationship between the political level and the regulatory level, we have seen over the last couple of decades a professionalizing of regulation. So, for example, the OSC, there is a memorandum of understanding between the OSC and the Ontario government whereby the OSC is mandated to make policy. And the minister is not going to jump in and get in the middle of that and say, oh, for this issue, never mind the memorandum of understanding, never mind the fact that we've mandated you to do policy, we'll do it. Like, that's just not going to happen. So I'd say, from my perspective, the greater responsibility, the greater onus, whether we like it or not, falls on us. We have to demonstrate, we have to respond to those 80, 90-page discussion papers with very considered opinion, with good research, preferably third-party research so that it's not biased. And then we have to put forward solutions to the real problems, and we have to help the regulator identify the real problems. So that's my perspective.
My view is there isn't a single stakeholder that is ultimately going to wear this, if you will. I think that was the language that was used. I think we're all fiduciaries to the end consumer. So we should all be accountable to the end investor, whether we're a regulator, a financial advisor, an asset manager, and so on. Our responsibility is to them first. So I think part of the problem with legislation is you come out with something and you don't actually understand the consequences of what you've put in place until many years later. So it's unlikely that we'll know what direction this will go in, because a lot of big decisions need to be made. Are we going to ban commissions or are we not? Is there going to be a fiduciary standard? What is it going to look like? And all of these will play a role. Ultimately, I tend to agree with Greg that it's really a political thing. And if the end consumer is hurt by the end of all this, and it's as a result of specific legislation that was put in place, then it would become a political issue.
Yeah. Sorry, Frank.
Well, I agree with everything that's been said. Being a person who has lived on both sides of the street on this one, I think that it's important to realize what is it that motivates regulators. And regulators are held accountable if something goes wrong. And so they always want to err on the side of caution. They always want to be, not 75, 80% sure things will work out, but rather, close to 98% sure that things will work out. So, your battery's somebody's cutting me off here. So I think one has to recognize that, and so it's really important. Like, our role is very much to demonstrate the unintended consequences that could occur, and to not only engage the regulator, because the regulator's motivations are different, but to engage, for example, the finance departments or indeed the minister if it's that significant, to kind of counterbalance it. Because my experience with ministers, and I've served, I think, about a dozen of them in my career, is that they will listen to the regulator simply because they don't want to be exposed if things do go wrong also. So you really have to demonstrate what is it that can occur, whether it's higher cost for significantly higher costs or less access or whatever. That is not the main concern of the regulator, but indeed should be the main concern of the finance department or the minister.
Thank you. We've actually come up to the end of the time allotted for this panel discussion. I think it could go on for another 2 hours. You wouldn't believe the number of really awesome questions that are here. I just would like to end by saying that I kind of left all of these questions to the end because they all pointed to a central theme. And the central theme throughout all of them is that how do middle and lower income Canadians get serviced for insurance and securities and mutual fund products when it's so costly to do business? It's not only that, how do life insurance advisors, how do they deal with the fact of low compensation in the later years as they're servicing clients, little to no compensations on very complex life insurance products? These are all very good questions, and I think would form part of another panel discussion that perhaps could go on to the symposium next year. But I think what we've learned today is that we can look at the industry and point to its faults. And it's so easy to say we don't have this. Like, we don't have any regulation in banning embedded commissions, and this is wrong, and other places do have it. Or that other places have fiduciary duties, and we don't particularly have it written down in regulatory fashion. We can point to that. But the reality is that we have a lot more here in Canada than what other countries have. We have a well-established and well-regulated insurance, securities, and mutual fund industry that, because the world has come together to talk about what is out there, we so often point to the things that we haven't done in Canada as not being done in Canada, regardless of the fact that it's not even applicable in Canada. We may have some other things. So let's focus on that when we're dealing with the regulators. I think it's also been said today, the importance of coming together as advisors. I remember when I was the chair of Advocis, I would deal with, some 50,000 advisors across Canada. And I think out of 50,000 advisors, 25,000 of them had a different idea about what Advocis should be doing, or what this industry should be doing, or about what this regulator should be doing, and why weren't they doing it. And as advisors, we have a responsibility too. We have a responsibility to be supporting the associations in our industry, the insurance companies, mutual fund companies, the securities dealers, the SROs, and so on, and to make our voice be known. And if we're going to sit back and mumble and complain about different things, we're going to be the recipient of exactly what we don't want. So I think that let's focus on the good and the power that we have, and let's make some great things happen for the regulatory environment within Canada. Thank you.
Thank you for the opportunity to participate in the Advocis Symposium 2014. If I sound a little groggy this morning, as my colleague said, I'm just coming in from China. First experience for me, wonderful experience for me, where I could exchange with my peers on the international scene. But if I have to stop and grab some water, or if I seem a little groggy to you, you'll know why. I view the relationship between the Financial Consumer Agency of Canada, FCAC for short, and the Canadian financial advisor community as a collaborative one, where both organizations share many of the same objectives regarding Canadian financial consumers. Today, I would like to outline my perspective on this collaboration and on FCAC's role as the Government of Canada leader in building consumer knowledge in financial matters, as a regulator, and as a promoter of consumer rights and responsibilities. But before I do that, I hope you will allow me to introduce the FCAC.
When it comes to making sense of the finances Canadians will need to make some of the most important decisions of their lives, it pays to know where to turn. Because the truth is, most things in life, for today and tomorrow, require money. As a government agency, we protect Canadian consumers by ensuring that the federally regulated financial institutions that they deal with on a daily basis comply with established rules and principles of market conduct. But protection is just one side of the coin. We also provide consumers with unbiased information about their rights and responsibilities when dealing with these institutions. We help to simplify things and connect the dots. We're here to assist consumers if they wish to file a complaint. By raising awareness of the importance of financial literacy and compliance, we are opening doors for consumers so they can make better financial decisions. With easy access to our more than 60 online interactive tools and publications, we are strengthening Canadian consumers' ability to manage their own finances. Possessing knowledge and a basic understanding of financial matters improves all of our lives. It helps us to get the things we need and want. As the government's leader in financial literacy, we are responsible for the collaboration and coordination of financial information. We make sure that this vital information reaches Canadian consumers through increased partnerships with government agencies, consumer and community groups, and other organizations. Sharpening consumers' financial knowledge and skills, making certain that Canadians can fully benefit from the financial protection they are entitled to. It's what we do by the numbers. It pays to know the Financial Consumer Agency of Canada.
Thank you. Hopefully that beats a long-winded list of things we're doing to meet our consumer protection and consumer education mandates. So what it all comes down to is ensuring that people get the right information and opportunities to develop skills and confidence to make wise financial decisions. The financial universe continues to grow in complexity, and that is a reality. We see a constant flow of new financial products and services emerge into the Canadian marketplace and continue to be dazzled by the technology behind these products. Who could ever have imagined the current volumes of mobile payments only 10 years ago? Another reality is that today's consumers are getting bombarded with vocabulary that perhaps 25 years ago did not exist. Think of e-deposits, e-transfers, TFSAs, HELOCs, RDSPs, RESPs. Even the most commonly used financial terms like credit, budgeting, savings can be very abstract to some. I myself find it perplexing to hear the bond prices on the nightly business report, and I'm sure I'm not the only one who does. And we won't even go into the emerging cryptocurrency business, currencies created by often unknown persons with transactions involving no financial institution, no regulations, and where there is no need to provide your real name to complete a transaction. But the truth is that more and more merchants are accepting digital currencies such as Bitcoins. So now it is quickly becoming a consumer issue. And all this may present some challenges to you, the industry professionals, but the consumer's challenge, making sense of this complex financial world, may be much greater, but this is where we can all make a difference. I find it amazing that so many people focus on saving a few dollars on household purchases or clothing, but have little awareness or understanding of the performance of their RRSP account or the actual interest rate on their credit card. And I'm convinced that as financial advisors, you must see that every day. Now, I don't intend to get into a behavioral economics lecture here this morning, but I do want to underline the premise for our action on financial literacy. And that is that people often make financial decisions based on very little knowledge. The Government of Canada has recognized the vital importance of financial literacy not only to individuals, but to the country's economy as a whole. Understanding the basic workings of money is an essential life skill. In 2007, recognizing the need to improve financial knowledge and the decision-making of consumers, the Government of Canada expanded FCAC's mandate from consumer protection and consumer education to officially include financial literacy and provided it with resources to develop a financial literacy program for youth. Then, in its 2008 budget, the government provided ongoing funding to FCAC to support efforts to improve financial literacy in Canada, not only among youth, but Canadians at large. Now, let's be clear. Our ambition is not to make people understand the bond market, but financial consumers should be aware of the returns on their savings, the actual cost of their debt, or the composition of their RRSP portfolio. Our conversation about financial literacy today is timely because, after all, November is Financial Literacy Month. And this year's theme is strengthening financial literacy through collaboration. And I'm particularly pleased to meet with individuals such as yourselves who can make a difference in raising the level of knowledge about financial matters. The baseline for our financial literacy initiatives is the Canadian Financial Capabilities Survey, which was fielded in 2009. This study gathered information from 15,000 Canadian adults and tested them in 5 areas: keeping track of expenses, planning ahead, staying informed, choosing products, and making ends meet. The survey results revealed that 40% of Canadians in at least 3 of the 5 areas I mentioned were weak. One of the questions that was asked was where respondents got their financial advice. And the answer may not surprise you. The 2 key sources of financial advice in Canada were banks at 41% and financial advisors and planners at 39%. And the sources of advice that most influenced their decisions about financial investments were knowledgeable friends at and we know how knowledgeable our friends are, at 43%, and financial advisors at 54%. So your counsel and guidance is hugely influential for Canadian consumers. And the fact that you enjoy this level of credibility with Canadians is very much to your credit. The 2009 survey raised concerns on the issue of financial preparedness and overall, and only 25% of Canadians scored at a high confidence level in all 5 areas tested. The survey results also showed that nearly half of Canadians have not taken that first step towards personal financial management, making a household budget. And more than half of Canadians between the ages of 18 and 29, and the majority of those over 70, do not have a budget. Nearly a third of Canadians struggle to keep up with bills and financial commitments. And of those Canadians planning to purchase a home, 48% have saved less than 5% of the cost, while 67% have saved less than 10% of the cost. The survey also found evidence that Canadians lack financial knowledge. 52% of Canadians planning to purchase a home were not expecting to incur any cost other than the down payment. Only 40% of Canadians had a good idea of how much money they needed to save to maintain their standard of living in retirement. And we're not the only organization to uncover these trends. In another study, the Canadian Institute of Chartered Accountants found that nearly half of all Canadians carry credit card balances from month to month, up from 1/3 from a few years previous. Fewer than half of Canadians are saving enough money from their paychecks for retirement, and nearly half of Canadians would find it hard to make the monthly payment on their mortgages and other debts if interest rates were to rise significantly. That last point is serious cause for concern. It reflects 2 weaknesses: the personal savings rate in Canada, which has been falling since 1982, and the level of debt many Canadians are carrying, a record high, in fact. Between April and June of this year, Statistics Canada says the average level of household debt compared to disposable income sat at 163.6%. That means Canadians owed something like $1.64 for every dollar they made. And that debt comes from sources such as lines of credit, car loans, and credit cards and mortgages. Now I have to ask myself, what's going to happen once these interest rates start to climb? How will Canadians be able to carry their debt loads then? The journey ahead could be bumpy for many, which makes it more important than ever to strengthen financial literacy skills. The data from the Capabilities Survey was our point of departure. Let's remember that in 2009, we were still in the midst of the 2008 economic crisis. So in response to this, the government launched its Economic Action Plan with the purpose of investing in businesses and individuals to foster growth and prosperity. In the spirit of the Economic Action Plan, the federal government announced the creation of Canada's Task Force on Financial Literacy. The task force was given the mandate to provide advice and recommendations to then Minister of Finance Flaherty on a national strategy to strengthen the financial literacy of Canadians. The task force report, tabled in 2011, concluded that financial literacy is essential to the prosperity and financial well-being of Canadians. I know that you don't have to split the atom to arrive at that conclusion, but it does need to be spelled out. And here's how the report formulates it. Financial literacy is having the knowledge, skills, and confidence to make responsible financial decisions. Knowledge refers to an understanding of personal and broader financial matters. Skills refer to the ability to apply that financial knowledge to everyday life. And confidence means having self-assurance to make important financial decisions. And responsible financial decisions refer to the ability of individuals to use the knowledge, skills, and confidence they have gained to make choices appropriate to their own circumstances, because we know what's good for one isn't necessarily good for another. The report made a total of 30 recommendations, which we are now acting upon. In April of this year, the government appointed Jane Rooney as Canada's first financial literacy leader. The focus of her mandate is coordinating and collaborating activities with stakeholders across the country to strengthen the financial literacy of Canadians. This involves close collaboration with individuals and organizations that have an interest in financial literacy, such as yourselves. The development of Canada's national strategy for financial literacy is the first order of business for the financial literacy leader. She has now established a national steering committee on financial literacy, and members of that committee will play an important role by providing input and advice on implementing the national strategy and by advancing the strategy within the sector they each represent. One of these members is Mr. Kerry List, President and CEO of the Financial Planning Standards Council. Work on a national strategy is being carried out in phases because as individuals, we all have different financial literacy needs at different stages in our lives. It also addresses the particular needs of priority group within Canada's population. For each phase, public consultations have been or will be held across the country. The first phase focused on seniors and those approaching this stage of their lives. As financial advisors, you are probably faced with the realities of people who are not financially ready for retirement. Everything about retirement has changed in the last few decades, including life expectancy and benefits available. The challenge is to provide Canadians with the financial information and guidance early enough to adequately prepare for and live in retirement. We recently conducted consultations across the country and have received input from many people and organizations. The first set of findings, those related to seniors, was published in October. The findings are very telling about seniors and provide some insight into some of the challenges they face. Here are some of the comments we heard. Seniors are a diverse population. This suggests that we need to communicate differently with different groups of seniors. There is a need for clear and simple communication. Decisions and behaviors early in life have a significant impact on seniors and their financial well-being. This highlights the need for the strategy to emphasize lifelong learning approach to financial literacy. Potential healthcare costs for seniors are not well understood, and this issue needs to be addressed. And finally, a number of submissions mention that the financial products and services available to low and moderate income seniors are more limited than one would hope. The Seniors Financial Literacy Strategy is now available on FCAC's website at itpaystoknow.gc.ca. We've now launched our consultation process for the next phase of the strategy, which focuses on priority groups such as low-income Canadians, Aboriginal peoples, newcomers, women, and persons living with a disability. One of our priorities is to engage key stakeholders from the sectors related to personal finances, including people in banking, insurance, real estate, and of course, financial advisors. Excuse me. The overarching national strategy will identify specific areas where professionals can contribute most effectively to the financial education of Canadians. We will be seeking their commitment for concrete actions to advance our common goals. The intention is to publish a broad-based strategy in 2015. Financial literacy is a national issue, and one that can only be addressed by working together. You meet people with the objective of ensuring they understand their financial goals and risk tolerance, and you match them with products and services that are appropriate. But beyond advising on financial products, you can help them become more informed and more knowledgeable. You therefore allow them to manage their money more wisely, reduce their debt load, and increase their long-term savings. Providing financial insight and sharing your understanding of the financial world not only helps people achieve their long-term goals, but it adds to the value of your service. The 2010 task force recommended that the Government of Canada provide Canadians with a single-source website for financial literacy with the objective of increasing public awareness. In response to this recommendation, the FCAC has developed a financial literacy resource database, a central gateway for all information related to financial literacy. I invite you to visit the financial literacy section of the website I referred to earlier, itpaystoknow.gc.ca, because this resource comprises, among other elements, links to materials, tools for the owners of those materials, to list them on FCAC's website, and an interface which the general public can use to search financial literacy information. Our job is to continue to monitor the evolution of financial literacy in Canada. Building on the 2009 results and using those as our benchmark, we have refielded the Canadian Financial Capability Survey this year, and we are releasing our findings as part of our National Conference on Financial Literacy, which starts tomorrow in Vancouver and which I'm heading to right after this. The 2014 iteration is testing the same 5 areas as the 2009 survey. In each area, financial services providers can help their clients achieve their goals by conveying the following messages. Live within your means. While you can't force your clients to spend less than they earn, you can make money-saving suggestions and inform them of the importance of paying down debt every month. Budget wisely. Though this may sound quite basic, it's important to explain the money savings benefit of careful budgeting and to point your clients in the direction of online or printed budget sheets or other budgeting materials. Plan ahead. Help your clients take full advantage of possible employer pension plans, match retirement savings, and learn about and use RRSPs, tax-free savings account, and other long-term savings vehicles. Choose products carefully. This is about helping clients choose products that have the appropriate costs and benefit for their lifestyle and level of income. Stay informed. Encourage your clients to seek out additional sources of information, such as FCAC's websites and its financial literacy resource database, where they will find a wealth of information to help them strengthen their financial acumen. Increasingly, financial literacy is looked upon as a pillar of consumer protection that permits a smooth and functioning market and stable economy. Since FCAC was created in 2001, financial education and strong supervision of federally regulated financial institutions have formed the basis of our consumer protection efforts. As you all know, the FCAC does not regulate financial advisors. But that doesn't mean that we're not interested in the relationships you have with your clients. In fact, we are interested in the protection and well-being of all Canadian consumers, regardless of whether they're dealing with a bank, an insurance company, a brokerage firm, or an advisor. Part of our role in protecting consumers involve overseeing legislation, voluntary commitments, and codes of conduct that apply to federally regulated financial institutions. Many of the rules and commitments we oversee are based on clear disclosure principles. Consumers need to understand when shopping around for financial products the options available to them, their features and benefits, and any limitations or risks associated with them. They need to be able to compare the products or services they are considering and understand the charges and fees associated with them to make decisions that are best suited to their circumstances. At FCAC, we hear about the issues that consumers encounter while navigating the complexities of the financial market down to the difficulties they experience when conducting day-to-day transactions. Whether it's a homeowner who doesn't have the information they need to make the choice between a conventional and a collateral charge mortgage, or a young adult with his first credit card who really doesn't understand how the interest rate is calculated on cash advances, or the penalty that is charged for late payments or unpaid balances. Or even still, as I did, the parent who loads funds onto a prepaid card for his or her child without knowing about the maintenance fees that are likely to chip away at the amount initially loaded on the card. My son told me never to do that to him again, because then he doesn't have the money that I promised him he would have. So as a regulator, it's important to remain responsive to these consumer issues. The Government of Canada has undertaken numerous initiatives to enhance product disclosure and consumer awareness. For example, Budget 2014 called on banks to better inform consumers of the costs and risks of collateral mortgages in comparison to conventional mortgages, and to equip borrowers with information that will facilitate their understanding of those products. As of September, 8 major banks and the Canadian Bankers Association have committed to providing consumers with enhanced information on mortgage security so that consumers have enough information when they are shopping around for a mortgage to make more informed decisions. And last May, new prepaid payment product regulations, you try saying that, came into force, and these apply to network-branded prepaid cards. Now, financial institutions must provide consumers with information about the fees in an information box on the product's exterior packaging. FCAC works with financial institutions to ensure that their products, policies, and practices comply with these rules and commitments so that consumers can increase their financial knowledge and ultimately make financial choices that are right for them. One of the emerging trends I see is consumers' growing comfort with using the services of payday lenders. Payday lenders whose rates tend to be quite a bit higher than conventional lenders. We all have a role to play in informing consumers that other options are available to them. As a starting point, they need to know that all Government of Canada checks under $1,500, whether for pension or social assistance, can be cashed for free at any Canadian bank. This is a right consumers have. There is therefore no reason for them to have to pay for that service through a payday lender. I'm fully aware that this issue has other dimensions to it, including social, integration, and mental health. All those matters need to be addressed as a whole. However, financial literacy and sound advice are important parts of the solution. We need to assist people in precarious situations to manage their affairs so that they are not stuck in the event of financial emergencies. So as I wrap up, I did want to tell you that I've had a chance to look at your public information, and I quickly realized that we share the same basic objectives when it comes to consumers. Your website reads, Advocis is at the forefront of consumer protection and promotes a model for delivery of financial services and products that places the consumer interest as the primary objective. It really comforts me to know that we are working towards the same end. So my message to you is the following. Consumer education and financial literacy are key elements of financial well-being. I look forward to a productive and successful collaboration with your industry. I think this is to everyone's benefits. Thank you very much. Sure. I can take my water.
Thank you very much for your presentation. It's great to see the progress we've made since the onset of the Literacy Commission. We did have a couple of questions for you. You described a number of emerging consumer trends in Canada's financial marketplace. For example, bitcoins and mobile payments. Are these trends a concern to consumer protection?
First of all, what I'd like to say is the Canadian Consumer Protection Framework is probably one of the strongest and most efficient in the world. And that's probably what contributed to our ability to withstand the financial crisis. And our Canadian banks really have a strong record of market conduct compliance. But having said that, digital currencies and mobile payments are trends that I am following closely. Digital currencies, I've asked my team to conduct some research to become knowledgeable about digital currencies, what they're all about, what the risks involved are. And what we've done with that research is we've created some consumer education materials which we've made available to consumers on our website. I invite you all to take a peek at those materials and give us your feedback. Mobile payments, well, I can say that when the agency was created back in 2001, mobile payments were probably in their infancy or non-existent, but now are prevalent. And I can tell you that when we first obtained, or when we first had our mandate expanded to conduct research, that was actually one of the first research paper we did. And the research looked at mobile payments and the current consumer protection framework and any gaps that existed in that framework. And the paper was remitted to our colleagues at the Department of Finance, the policymakers, to inform their policy making. But we also, as a result of the research paper, again, consumer education is very important. We've completed and developed consumer education materials so that, because I personally think mobile payments are very convenient. But with that convenience comes risk. And it's our job to tell consumers what those risks are. So that's what we're doing on the mobile payments front, and we are working with our colleagues at the Department of Finance to help them develop their policy making. And just if I may, just a third trend that I worry about is the unregulated or predatory lenders. I touched upon that in my speech a little bit, and that's really where consumer education is vital. Consumers have to know that they have other options. It's very comfortable for them to walk into a payday lender. It's less intimidating than walking into a financial institution. And quite frankly, I think that perhaps there's a role for our financial institutions there to make their micro lending more accessible to some more vulnerable populations.
Thank you very much. I'd have to say it is more welcoming to go into a payday lender, but I've only been in shortly. So, by the way, my wife missed the trend about dropping savings and increasing debt. It seems she's got me on a completely different program. You say Canadians benefit from one of the most effective consumer protection frameworks in the world, but we've recognized this morning that financial consumers are engaging in an evolving environment marked by rapid changes in technology, innovation, and the introduction of increasingly complex financial products. What would you recommend, or what are your thoughts around what you might suggest to the regulators that they need to be doing to be on the forefront of these emerging trends?
So I have to ask, have you ever done stand-up, or? You're quite comical. Actually, this is something that in China, when we were meeting with the international regulators, my international counterparts, I actually did a keynote speech on just that. And I think that today's regulators have to do things a little differently. And what that means is that, in my view anyway, they have to be more proactive and preemptive. So it's not about coming in as an enforcer, in my view. There also has to be respectful, collaborative approach to supervision. So rather than, again, coming in heavy-handedly and having almost an anti-business approach. And also, I think that regulators must become prominent thought leaders in my area anyway, in consumer protection, rather than just watching by the sidelines. And let me expand a little bit on that. We oversee FERFIs, federally regulated financial institutions. It took me about a year to get that right, but essentially banks, trust companies. And we oversee their compliance with the legislation and regulation that is designed to protect consumers. And so, since I've been appointed as commissioner, the way we do that is, rather than come in after the fact, lay down the law, and demand that problems be fixed, we get the financial institution to involve us in their processes from the outset so that we can work with them to bring them into compliance. Because our aim is really to avert potential harm to consumers. And it's much better than to have to mop up after issues have already surfaced. So, in my view, it's very important to maintain strong and open dialogue with the entities we supervise.
I have to thank you for your clarity of communication and the leadership of which you're bringing to this particular area. We have one last question, which is, can you expand a little bit on what your group is doing and has planned for the November's Financial Literacy Month, so that we might engage in it and share in your endeavors?
So November is Movember, but is also Financial Literacy Month. Yay, I don't have a mustache. I could have worn a fake one, I guess, but when we launched Financial Literacy Month earlier when I was in China, we actually, in collaboration with the Canadian Bankers Association, launched a new financial literacy resource for seniors called Your Money Seniors, YOMO Seniors. And that consists of an hour seminar that retired bankers give to seniors, either at their community, through their community organization or others, and to really help seniors understand how to manage their money in retirement, because it's not obvious to some seniors how to manage their money in retirement. We've also, I'm on my way to Vancouver for what I referred to as the National Financial Literacy Conference, which is our fourth conference. We typically hold these conferences every 4 years, or 3 years rather. And the conference brings together experts, industry, not-for-profit organization, and I know many of you actually told me we're attending, so yay, we'll see you out in Vancouver. And the conference will really present speakers from across Canada and across the world to highlight the latest research, emerging trends, and example of successful collaboration in financial literacy. We've also had a contest. We used to have a video contest for students in school on financial literacy, but this year we decided, a lot of organizations are doing video contests, we decided to do a selfie contest. And the selfie is my financial selfie. And so to participate, contestants have to submit a selfie showing how they put their financial skills to use or how they helped educate others about financial literacy. If you're interested in seeing my selfie, you can go on our Facebook page. It's right there. You'll also see Minister Sorensen's selfie and Jane Rooney, our leader's selfie as well. So we've encouraged people to get on the financial literacy bandwagon this year through a selfie contest. And we also have a calendar of events that we maintain, whereby organizations populate their events and their resources for the month of November. And those events, that calendar is available to everyone through, again, itpaystoknow.gc.ca. And by the way, you can all participate. If you have an event, if you're giving a seminar, if you're going into a school, into a class, you can enter your event in the calendar. We'd be pleased to be able to leverage what you're doing. As a regulator, it's very rare that I get an opportunity to leverage, first of all, what the financial institutions I regulate are doing, the good work that they're doing in the space, but it also allows me to leverage all the good work that's going on with respect to financial literacy, and I'd love to promote through the calendar the good work that you're doing. Thank you very much.
You probably couldn't find a room of people more interested in improving and increasing financial literacy than the financial advisors in this room. And so we're very glad to hear what you're doing to really include some of the very vulnerable groups in our society, the young, the old, the disadvantaged, and it's terrific work. I'd like to give a warm appreciation of applause for you for your contribution today. Thank you for being part of our show.